Hello guys, it's Tom here from the WB Trading team, and on today's video we're going to continue our series on what's required to become a successful trader and focus on the major mistakes that we see traders make, certainly when they're starting out, and also how to avoid those mistakes. As always, if you have any questions or suggestions for new topics that you'd like to see us cover, please leave them below, and don't forget to subscribe to catch up whenever we get a new video out. With that being said, let's get into today's video. Just very quickly before we dive in, if you're still struggling with your trading or you'd like to know more about how mechanical edges are traded, I've put together a free video course for you that will map out and explain everything in detail, along with walking you through exactly how the mechanical rules actually work. If you'd like to watch that after this video, I'll pop a link in the description. You can click through and you can watch that straight away. What we're going to cover today not only comes from my own experiences, where I can certainly remember making quite a few of these mistakes, and I'm sure quite a lot of you listening will be familiar with these, but it also comes from speaking to a lot of traders when they sign up and join our course. On the one-to-one call, on the introductory calls, the first thing I'll ask is, right, let me know your trading background, let me know your trading experience. And time again, I'll hear these mistakes repeated. Sometimes I think they are easy mistakes to remove. Sometimes they are quite tricky, but it always surprises me that a lot of traders keep falling down those traps. And when I look online and try and find out what information is out there, there isn't a huge amount compared to the amount of material to say do this, or this is the only strategy you need. There's not that much focus on where these mistakes are coming from. So really, this is what I want to try and dig into today. The first area I see traders making a mistake, and it's certainly one that I made when I started, was incorrectly managing my risk, or in some cases from traders not managing their risk at all. Now, when we're talking about risk, we can look at a few things here, and some of you may think, oh, Tom, are you referring to risk and reward, the R number that we've talked about in previous recent videos? But what I'm talking about here is our risk management, the actual monetary risk that we place on every trade, and also how to protect our account. So what we're talking about here is risk in percentage terms. And the first area that traders tend to make mistakes on is not managing that risk percentage consistently. So with every trade, what we should be aiming to do is have a consistent percentage of our account dedicated to each trade. So if we lose a trade, we know what percentage of our account we're going to drop down by, and therefore protect ourselves from drawdown. Also by keeping that percentage very low. The mistakes tend to come from traders when they don't manage this at all, and suddenly you're placing trades using 20% of your account, 30% of your account. I've even seen higher risks, and obviously with that, a few bad trades and your account has been completely wiped out. Now, one thing I've heard from traders in the past is they've said, oh, Tom, okay, understand that, but I'm trading, I'm not gonna get 2 or 3 losses in a row. And that's always made me laugh, because if somebody's telling you that they've given you a strategy or you're learning something that's not going to have the risk of a 2 or 3 trade drawdown, you need to walk away as quickly as possible, because that happens to every trader. And this is why we need a consistent and safe risk management policy. You might be thinking at this point, well, why are people risking that much? What is the benefit there? And it really comes down to traders who are just starting out most of the time, trying to grow an account very quickly, trying to really up their risk and therefore up the reward. And okay, maybe 1 in 1,000 times it will work and they'll grow an account quite quickly, but that'll only be very temporary. And I've seen that certainly less than 5 times over my years in trading, and anybody that's made big profits quickly has always ended up giving them back eventually, because they can't get out of that habit of high risk and reward, and eventually it's just completely destructive. So let's have a look at what is a good risk management policy and what is a bad one, and how they compare. To show the calculations, I'm just going to use an account size of £5,000. Please bear in mind though, these rules, they should be followed regardless of your account size. This isn't something that we should start to implement once we've got an account at a certain amount. These should be from very much day one of your trading. So on the screen right now, I've just got a comparison between kind of what I consider to be a bad risk management policy and a good one using this £5,000 account size, and how we can work out our percentage risk on a particular trade. And this is going to show us how much we stand to lose if the trade comes back and hits our stop loss. Now, this is only showing it for one trade. We're going to have a look now at what happens if we run into a drawdown and compare the account changes if that occurs. And this point, I think, is where, if you haven't come across risk management before, it's really going to open your eyes to show you why we need that good risk management policy to protect us. So as you can see here, after a few losses, the position you'd be in with a bad risk management policy, it's almost impossible to get back to break even. Not just from a calculation point of view, because the percentages get pretty ridiculous quite quickly, but from a psychological point of view. This tends to break traders when it gets to this point. They just think, right, that's an account blown, or they just up their risk even more. Whereas with a strong risk management policy, okay, we've had a little bit of a drawdown, but we're only a few percentage away from where we were at break even. We can recover from this, and therefore it really does protect you. I can't emphasize that enough. Certainly your mental well-being as well as a trader, that really helps to say, okay, we know we're in a position that we can recover from. To summarize then on risk management and avoiding that key mistake that a lot of traders make, we need to always start out with any strategy to have that strong risk management policy in place. Not something you want to certainly add in later down the line. You don't want to go in thinking, I'm just going to try and grow this account as quickly as possible. This is a patient approach. And this is what we need to take if you're going to get that long-term consistency while you're learning to trade. Now we've looked at risk management and the importance of having that strong risk management policy in place. Let's look at a couple of other areas that I think traders always seem to struggle with when they're starting out. We're going to combine two in one here because we're going to look through over trading, and we're going to look at the concept of strategy hopping and also revenge trading. So first up, let's define what we're talking about here. So strategy hopping is when traders maybe pick up one strategy, they take a couple of trades, they go, this isn't working for me, they look for the next strategy on the internet. They jump on that, they do the same thing, and they move around and around, never being happy with the results they're seeing after only a handful of trades. Revenge trading is similar, and it can lead to strategy hopping, but it's also a case of when basically traders are using a strategy, they've lost a couple of trades, and then they say, oh, I'm just going to gamble, I'm just going to place a trade here when I know I shouldn't, no rules in place, I just want to make my money back for the day. They might be down 2 or 3 trades, maybe down 3 or 4% in the day. They want to try and make that back as quickly as possible, and they start revenge trading. Now, certainly, I can remember being guilty of probably both of these when I started trading. Certainly more strategy hopping than revenge trading, but I know they are both common issues and they come up a lot. And certainly if you're a newer trader or an experienced trader even, it's likely that you've done one of these in the past to an extent. So let's talk about kind of really why they're negative and what we can do to avoid them. Now, the reason I've combined these two into this section is really because they both deal with the psychological aspect from traders where they're unsatisfied with their strategy performance. So this isn't looking at, just profit and loss, although that does come into it, certainly. It's looking at, what is your win rate? What is your average R, etc. So it's different from risk management where traders are trying to grow an account really quickly. A lot of times traders that are making that risk management mistake we talked about earlier are also making these errors, but they are slightly independent as well. What it really comes down to is traders' expectations of where their win rate will be and what trading performance and drawdown they really should expect. And this is where, newer traders certainly, and it's a fault certainly of a lot of the information out there, but their expectations are set too high. And when it comes to reality, particularly when you're starting to trade and you're going to make the majority of those mistakes, traders are left dissatisfied with their performance and they'll start looking elsewhere. This doesn't mean that you should just accept and continue trading, with poor strategy rules or anything, but there has to be a point at which you accept there's going to be some drawdown. And this is where strategy hopping and revenge trading really comes in. So you might have just started to learn a new strategy and you're 4 or 5 trades in and maybe you've had one win. And It might have been a fairly small win as well, let's say a 2R win, so you are down. For experienced traders, and certainly the strategies that I use, yeah, that does happen. We get those drawdown periods, absolutely. I know long term that they're going to be smaller than the profitable periods, but that does happen. For newer traders though, they immediately panic. And I can remember, and I've been there, but they immediately go, okay, I'm going to start looking elsewhere. This isn't good enough. I should be winning every trade, which obviously isn't true. So they drop that strategy and they go, okay, I'm going to look elsewhere. And you go online, you have a look through, you find some of those traders and some of the strategies that say, guaranteed, 90% win rate, etc. And it draws traders in. And they'll start doing those strategies, realize that actually they're not all they're cracked up to be. And yeah, they'll go through a couple of trades, maybe a couple of losses, and they'll do exactly the same thing again. They'll go, this isn't working, right, I'll look for the next thing. And they just get stuck in that cycle. And it is a dangerous cycle because you're never learning. You're just dropping it after a couple of trades and moving on without looking for any potential improvements. And this is where strategy hopping becomes really dangerous. Let's now have a look at revenge trading. So, in short, revenge trading is really the problem that comes from traders having an emotional response to a poor performance. It could be a case of saying, okay, there might be 2 or 3 trades down in the day, and you're thinking, I've got to finish this day on break even. I can't finish this day with, a -2%, -3% day. So what ends up happening is they ignore strategy rules and they just start placing trades, often completely randomly, just to think, okay, if I could only get one of these to be a winner, I can get back to break even, then I'll start the next day, I'll trade my strategy rules, I'll do everything right. And of course, sometimes they do get back to break even, often they don't, but in general, the problem becomes they do this more and more often. They do this to try and get themselves out of the problems every time. And inevitably, it just leads them to blowing up their accounts. They try and chase that idea of getting back to break even, and it just doesn't work. You need to be able to sit there and say, okay, on some days, I'm going to finish, 1%, 2%, 3% down for the day. And we'll make it back. Because again, coming back to what we said in the strategy hopping section, we're looking at long-term results. So the process of removing revenge trading, certainly in my experience, is a little different to what we looked at for strategy hopping. I think the key element to try and avoid any revenge trading is to have in your trading plan a very clear idea of when you will walk away from the screens, might be each day, each week. And what I mean by that is to say to yourself, okay, have a rule to put in place, say to yourself, okay, when I get to maybe -3R, or -2R, whatever it is during the day, I'm going to stop trading altogether. Doesn't matter if there are other trades available with my strategy rules. I know at that point I get emotional. You might say that to yourself, or it might be over a week. You might say, if I'm 5% down over the week, I stop trading for the rest of the week. I walk away, I take some time out, and I come back the next week. And have that rule in place. And the rule should be different for every trader. You will know yourself when you start to get emotional and when you start to maybe look for revenge trades, if that's something that you've been guilty of doing. That kind of rule will really, really help. It'll give you a fail-safe. It'll say, stop trading right now, walk away, come back the next morning or the next week with a clearer head. So there's just a few of the really important issues and mistakes that I see a lot of traders make when they start out. And of course, as we mentioned at the start, this is a key element to how we succeed as traders, is removing these mistakes. This alone won't get you to that successful trader stage, and this is why we have the series of videos going through different aspects. But I certainly hope that today has highlighted some areas that maybe you thought, actually I'm making these mistakes, but how do I get out of them? Or maybe they're areas that you haven't come across so far. And it's always good to watch out for these and have that plan in place, even if you're not making those mistakes just yet. As always, guys, thank you very much for watching. Any comments, any suggestions on future topics, please leave them below. If you'd like to book a call with one of the team, just find out a little bit more about our trading style, the link's in the description as well. Thanks for watching, guys.